Hey, good morning, viewers. Thank you so much for joining on the 100x live show with Rajesh Sehgal. Uh, Fundraising is an art and a very important skill to master to ensure that your future of startup is towards success. This session is all about learning things of do's and don'ts while you are pitching to investors, and how do you scale your early stage startup and business quickly, rapidly. Rajesh Sehgal, I have known him personally, an astute investor. Rajesh has learned the ropes of discovering and backing entrepreneurs who can see the future correctly, and rightfully so, the way his portfolio speaks for itself. Today he's going to help startup founders navigate venture capital quagmire with simple rules of do's and don'ts, what needs to be done, how it needs to be built across. I mean, there is no one straight route to success as said across, and each one has its own journey. But fundamentals of venture capital investment remains the same. So, briefly, Rajesh is the founder and managing partner at Equanimity Investments, and he has been a prolific angel investor over a decade and developed a deep understanding of Indian entrepreneurial and innovation ecosystem. He is active member at Mumbai Angels, founding and current chair at Corporate Report Users Forum. He's a Thai Mumbai board member and co-chairs, the FinTech Special Interest Group. He's also member of steering committee of NASCOM 10,000 startups. So Rajesh is an astute investor, and I have worked with him, and I can vouch the way he does his investment kind of stuff. So Rajesh, thank you for coming on 100x Live. And what would be your opening remarks on the current crisis and what you are looking around in the venture capital world? What are your portfolio companies doing? What is your view in the current crisis?
So good morning, Sanjay, and first of all, thanks for having me here, and also for all the kind words that you just said. But I must say that we've known each other for a long time. We have common investments as well. So I think the respect is mutual. The professional respect is very reciprocated here. So again, thanks for having me here and letting me share this platform and sharing my thoughts. I think on your question about where we are in the current crisis and how I am seeing things pan out from my perspective, I would say that this is, first of all, not as bad as it is made out to be. We all agree it's bad. I mean, there's no question about it. I'm not going to paint a rosy picture here. So it is bad, but I don't think, and I've never subscribed to the thought that it is as bad as people think it is. Life continues, business continues. We are seeing in our portfolio itself, forget about the broad wide world. There are companies that are, actually benefiting from the current scenario. They are doing extremely well. We have more than two companies which are at or near record high sales in terms of, and these are all early stage companies, right? Of course, there are others who are suffering, who have no business. So, for example, if you are running a mall or a gym chain or some of those businesses, of course, there is no business for now. How we are, or at least I am trying to navigate the current scenario is by focusing on the basics. I think as an investor, and I would say the same as an entrepreneur, you got to focus on the basics. Look for right people to work with. So hiring becomes very important. Managing your team in this environment is very crucial, not only for startups but also for larger businesses. So one of the things that I've kept repeating again and again is communicate, communicate, over communicate. So one of the advice that I have for everybody here is when you are, in a situation that we all are in, it will help if we over communicate. Never think that you're overdoing it. Just spread the message out. Whatever it is, your thought process, the way you're managing things, decisions that you've taken. For example, most of us have taken a decision, at least in the startup world, of salary cuts or restructuring the salary packages to garner them or orient them more towards a variable structure. Communicate why is it necessary. We've had examples of companies where employees have come forward themselves, and these are startups, so it's a tight community, it's a tight team, right? The employees have come forward themselves and said, you know what, we understand the scenario, and let's discuss how we can pitch in and how we can help to make sure that we all survive to see the end of this tunnel. So Sanjay, in short, it's a tough time. It's a tough scenario for all of us. Everybody is pitching in with whatever they can, but I think it is extremely beneficial for all of us to remember that this will end sooner or later, and we have to be ready to capitalize on the world after that.
Awesome. Thank you on that positive note. Let's get into the topic of early stage, funding and scaling. What are your views on early stage startup? What is an early stage startup? How do you define the stages in a life cycle of a startup? So what are your views, right? How do you call one startup an early stage startup?
Yeah, it's a tough one. I think we are all familiar with the life cycle of a business, and when a business is conceived, when an idea is germinated, and then infused with capital, and customer I think that's very a sign of a business that can really grow up to be a large, mature corporate. Uh, I've worked with larger companies. In my earlier avatar, I used to work very closely on the boards of large listed companies. And I can assure you that even there, some of the conversation was around how can we behave like a startup? How can we behave, even though we are large, mature companies? How can we behave in a manner that we come across and are able to be very, very nimble footed? So there are some of the traits that startups have, and I would go by that definition rather than any size in terms of revenues or team, etc. All that is, we all know that. But I think it's being a startup or an early stage startup is, in my opinion, all in the mindset. If you think that you can be, despite whatever your size is or the structure is, if you can be very, very nimble footed, then you are a startup in your mindset, in the way you think, the way you execute, the way you do things, your decision making. I think everything has to speak to, if I were to pick just one trait, I think that would be nimble footed. So when you go around setting up your business, scaling up, getting more and more clients, hiring larger teams, going to from one city where you start, you go to other cities, other geographies. I think if you are able to remain nimble footed, then I think you are still a startup, and that is why the press also refers to companies like Flipkart, which is like a multi-billion-dollar entity, as a startup.
Sure. So, Rajesh, from a sector perspective, in the way stage where you invest, which would be an early stage, in what kind of size of companies you would typically, as an venture capitalist, would invest across?
Ah, so from Equanimity's perspective, we are early stage investors. We call ourselves that. Thus, we even though even though, as I said, we are investing in early stage companies, we've tried to keep our mandate very, very flexible. So in terms of sectors, Sanjay, we are investing all across. We have no preference for any one sector over the other. In terms of size of revenues, pre-revenue, post-revenue, or in terms of capital raised, etc. We have very broad contours that we like to see in those companies. We like to see a certain kind of cap table, etc. But those are not hard limits or hard rules for us. Those are guideposts. So when we evaluate companies across sectors, I think we are very, very carefully looking at, again, the basics. People, right? Who the founders, the founding team. How is their chemistry? How do they work? How do they think? We spend a lot of time with founders, both officially, nowadays on Zoom, earlier in the office, but also outside, socially. You got to understand, and as much as you want to understand them, I think it's important for them to understand you as well.
Sure,
Because remember, for magic to happen, there has to be chemistry, and there's no shortcut to that. There is no other way of knowing it. You can't read off chemistry from a pitch deck or from some diligence documents, or some legal agreements. It is the chemistry that you have with the founding team, and so you have to think of them as people whom you want to spend the next 5-10 years with. And I think
sure.
equally important is they have to think that they can spend time with you over the next 5 to 10 years.
Awesome. Very, very, very rightly said. it's you can't be just reading a pitch deck and investing. You need to be
Yeah.
meeting across founders. Well, what's your view on it? Should startup go out and pitch to VC directly as they start across, or they should go through a friends and family round, an angel round, and then go to VC? What's your view on that? Line of thought.
See, if I were to advise Sanjay, you and I both know, capital is essential for growth,
Sure,
right?
sure.
So, if I were to put myself in the shoes of an entrepreneur, I would say, boss, जहाँ से पैसा मिलता है, पहले तो पैसा लो, right? Because without that, you can't survive. There is no life for you after that.
Sure,
That is question number one, the first level of thinking. But the second level of thinking then becomes quality of that money, right?
sure.
As a VC, I can assure you that one of the important signs that I look for before we are evaluating companies is friends and family. Company, a startup business, and you want to scale it up to glorious heights, you have to have so far gained the confidence and trust of your family and friends. And if you
Sure.
have, that's a huge positive in my opinion. So friends and family round, I think, is the first thing you should do, recommended. But there is no hard and fast rule. I mean, if you have a plan where you think that you have a plan, and B, you have the confidence to convince people about your vision, and share your vision with people, by all means go out and raise VC capital before you do anything else. It's going to be a heck of a lot difficult to do it, I can tell you that. But there's no harm in trying. You have to balance this trying philosophy with the cost benefit part of it, and only you as a founder can decide that. How much effort and time will it take to get that capital, and how much effort and time could you have used in your business to scale it up to a level where VCs or larger institutional investors have some kind of proof about your plans and your scaling up. So you got to balance both of those.
Awesome. So we got few questions coming up, Rajesh. If you don't mind, can I pull it up
Huh?
on the screen in between, kind of while we do
Yeah,
that?
sure. Of course. Of
So
course.
Ashok is talking about saying that how can one take learnings from startups and extrapolate to medium-sized companies, particularly in the COVID times. So if you can just
Yeah.
highlight on that stuff.
Yeah, the question is to you and me, so I think you should go first.
No, no, you are my guest. It's all your show. I'm just trying
Okay.
to get your
I
views
think
to the entrepreneurs.
fair enough. Fair enough. It is something that I've highlighted earlier in the beginning of my of our talk itself. For early stage companies or for medium sized companies, SMEs, or even for large scale companies, the way to behave is, in these times, in COVID times, I think one of the basic things that we've done is we've told companies and entrepreneurs or anybody who's running a business is to look at your cost structures very, very closely. And in normal times, we have fixed costs and variable costs. It's a normal accounting thing. I think in these times, we've encouraged all entrepreneurs to just don't think of anything as fixed. There is nothing called fixed cost. Everything is variable. And that's a survival technique. You have to, even if you're an SME, you have to think of all your costs as variable. What are the costs that you can link to your revenues? So we've had companies where the number of employees were I think 110, and because of what's going on, quite a few of them left by themselves because they had to go back to where they were from. Quite a few of them we had to let go, etc. And the others who remain were very clear that their life has also changed, as have the lives of founders. So their compensation, their upside were clearly linked to revenues. And this is where, when you try to do this kind of thing, it's very important that you again, communicate and over communicate. And they should, your employee base, your team has to buy into your philosophy and the way you're managing things. So the more transparent you are, the more you communicate, the easier it becomes for you as a business to survive.
Awesome.
So nimble footed.
One more
and
question.
think of
Yeah,
everything as variable.
sure. No,
Sanjay.
that's a great way to question every process and every spend and whatever you do across. We got one more question from Jagdish Das. How do you build a team? In these times.
I think it's a great. It's a great time to build a great team. For a very simple reason that we know that the unemployment levels are what they are. If I've seen the last number right, it's still over 20% unemployment rates. And this is not just at the lower level. We are seeing such kind of unemployment levels even at pretty senior positions as well. So talent is available, and these are people who have been there, done that, have credentials to share. So in my opinion, this is a good time to build a great team because you will get access to talent if you as a business are able to accept the risk of paying for the talent. So that is a good thing. You have reached in your business plan, in your business plan. I think it's a matter of matching up. So just spread the word around. Even in these times, I mean, I just forget about everything else. Just look at LinkedIn. I mean, there's so many profiles out there. People who are looking for opportunities. At the same time, there are so many profiles out there of startups who are wanting to build teams. So as I said, it's not as negative or as bad as people are making it out to be. Of course, there are challenge. It's a challenging time, but there are as many opportunities. So this is, in my opinion, a good time to build a team. How do you do that? Just put your word out there that this is what you're doing. This is the kind of people looking for. Headhunters. Everybody's working from home, right? They're all busy. So reach out
Sure.
to that community as well, and I'm sure you will be able to build a good team.
Awesome. Thank you so much, Rajesh. Coming back to our set of questions, which I wanted to ask, how do you
Yeah.
evaluate deals, Rajesh? What is your recommendation to startup entrepreneurs when pitching to Equanimity VC fund? What is the
Mm.
process? How does one work and reach out to you? What do you look into startups as an Equanimity?
Uh, I think we look for the same things like you do, Sajay. We're all looking for a great set of founders who are addressing a large, sizable opportunity. And
Hmm.
third part is that they have the capability to execute the plan that they're thinking of. So I think as long as these three things are in place, that you're dealing with the right set of people who are trying to address a very large, scalable opportunity. And third is, in your opinion, as an investor, the team has a capability of executing a plan to achieve, this great business plan. I think if to cut everything short, if these three things are in place, for us it's a go. We will look at it very closely. We've looked at a few of your companies very closely, Sanjay, since you started this new 100x, and some of them we found very very interesting. Great set of entrepreneurs who are trying to address larger opportunities and do have the capability of executing the business plan that they've laid out. So
Sure.
to cut a long list of things that we look at because we have a very detailed diligence process. I think for anyone to get into our process, these three things have to tick off.
Okay. Awesome. So what's your filter, right? What are the deals that you don't do, right? Or these are the deals Rajesh will never invest into? What are the big no-nos?
Yeah, very simple. Burn. There are business. So here's from my experience, I've seen that if I were to just very simply divide the world into two parts, then there are those founders and those business plans and those teams that are trying to set up a large business, right? And then there is another set of entrepreneurs and teams and founders who are trying to set up the next benchmark for valuation, right? So there are people who are chasing a larger business, with valuation being important, and then there are people who are chasing larger valuations with a certain business in mind. Right? So there are two sets of entrepreneurs. Uh, for us, clearly, those businesses are very, difficult to assess and manage. Where the founders or the entrepreneurs' mindset is more about valuation, and it's a valuation game. There's nothing right or wrong about these two buckets. It's just the way we look at it. Our approach to investing is more about working with the entrepreneurs over the next 5-10 years, trying to really build up something of value and meaning and something meaningful. And that gives us immense joy. So the whole team that we have, we all get towards figuring out from the mindset of entrepreneurs whether they believe more in just chasing valuations. And there's, as I said, there's nothing wrong with that. It's just not our mindset. Our mindset is more of, if you execute a greater business plan, if you are able to set up a larger scalable business, valuation will follow, right? And we all want as investors the valuations to go up, because we gain only when the value goes up. So we are all aligned on that aspect. But I think we are clearly not looking at those businesses or those pitch decks or those plans that we regularly get, where we get a sense that it's not about setting up that business. It's more about going with the flow. अरे यहाँ पे valuation मिलेगा, यहाँ पे we'll get a few $1 million to do stuff, and therefore let's try our hand at it. So that is one thing, one way in which we distinguish about things that we will and we won't. And then I said about burn. So those businesses, by definition, people who are seeking higher and higher valuations, in our experience, are typically those businesses where the founder team is attuned more towards increasing the burn and therefore increasing the race or the targeted market, and therefore higher valuations. We tend to at Equanimity, we tend to work with companies where burn is not a bad word, but burn is understood as an initial cost to starting off on your trajectory. So we will have to invest money, and the companies will not be making profits for in the foreseeable future, and we all understand that. But it's about the mindset. If your mindset is more about, let's just keep growing in size regardless of whether we are creating value or not, versus let's grow in size and create value. So as long as you're growing in size and creating value, great. We are, those are our kinds of businesses. And we've seen businesses, Sanjay, all across sectors, by the way, who are attuned to, in either of those buckets.
Sure. So we've got a couple of questions coming back to audience question. Lot of questions are there, but I'm picking few of it, kind of stuff. So Varun is asking across, do VC fund any startup product which are into ideation stage and has potential of becoming a promising product, or VCs invest into startups which are already bootstrap and then going out to look for funding?
Yeah, Varun, there are both kinds of VCs. The VC community, thankfully, in India now is growing by the day. There are lots and lots of funds out there, and therefore there's enough and more capital to address both the areas that you laid out. So there are VCs who will invest in an idea, and then there are VCs who will invest once they see a bootstrap business, they see some kind of traction, they see some contour to your plan, etc. Just to be clear, at Equanimity, we favor those businesses which have already been executed or bootstrapped, or there's something to show. So if I were to get a plan where Varun has a great business idea, but he's still holding on to his job and says that I will quit my job when I get funding, then it's not our kind of business. We do not fund, or we do not go down that path very clearly, and I'm being transparent about that. But if Varun has a business plan and he says, you know what, here's my job, here's my business plan, now I've quit this, and I have only 10 lakh rupees or 5 lakh rupees or whatever lakhs of rupees, and I'm putting that money and I'm trying to set this up. But so far, I don't have the tech built out, I don't have the team, I don't have any revenues, etc. Will you look at it? Answer is yes, yeah, we will look at it. So we are okay to look at pre-revenue, post-revenue, but as long as we find that your commitment is there as a founder and as a team.
Yeah, so most of the founders, if you are on sidelines, please jump into it, show your skin in the game, and
Yeah,
VCs will definitely look at it, and that's what Rajesh is trying to put across. Rajesh, we have got two questions, very similar. I'll just pull up both of them, and then you can, combine the answers. So one is
sure.
Chirag is, what is the right way to pitch to any VC? What factor they look actually? You already answered some bit of it, but if you can throw more light. And secondly, is coming up from Abhimanyu on YouTube, is how do you evaluate investment potential of an early stage startup with viable MVP and raising funds? So how would you answer that?
Yeah. Yeah, actually, you're right. We just touched upon a few of these points earlier. I'll delve a little into details now while answering this. So how do you pitch to a VC, your business? I think every investor is out there finding out good investment opportunities, and I think we all agree on that. So whether an investor, whether it's a VC or an angel investor or anybody else, is wanting to look at your business plan or not depends on whether your business plan fits into their scheme of things. So I think the first starting point for any entrepreneur should be, evaluating the VC firm that you're approaching. And the good news there is that VCs, people like us as a community, are always out there talking about what we want, what we are looking for, and different VC firms look for different things. So I think a good starting point for you will be to do a little bit of background research on which firms align with what you're trying to do, right? So if you're building a product and it is still early stage, it's still not out there, then there are certain investors who will not look at it, and there are certain other investors who will look at it favorably. So it's your research. So that's starting, point number one. Second thing, when you're pitching to any VC investor I termed it earlier as chemistry. So the chemistry has to be right. You have to, while you're pitching to the VC and the VC is evaluating your business plan and obviously evaluating you and the team as people that they can back up, and they see, value come out of it. And, you, the founder, and your team also have to be doing your background research on the investor. Because as I said, the first thing important for any startup is to get the capital. So it doesn't matter where it comes from. That's stage one. But stage two is, once the capital has come in, you will ask those questions about the quality of capital. Is it patient capital? Are these investors with the mindset that they will allow me to execute my plan and back it up, and and play the role of a mentor and steer it in the right direction? Or is this an investor? And a lot of entrepreneurs come to us with this fear, by the way, of, if we take money from any investor, then the investor starts to think that they are the boss and we are just working for them. And I'm sure, this fear that founders have is not unfounded. There will be investors who behave like that. It will be a travesty if you were to find out the nature of the investor after the investment is made. So please do your research upfront. And the startup community, at least in my experience, the entrepreneurial community is very tight knit. So just spread the word around, ask around, and you will get that feedback that you're looking for. So those are a couple of things that you should look at when you're approaching VCs to raise funds. And then, of course, you have to evaluate what they've done. The VC firms have done in their earlier investments. What are the current investments that they have? So that when you're pitching your idea to the VC, you factor in all of that and you try to understand what the VC is looking for. So, as I said, if I am looking for companies that are, can be very highly scaled up with minimal kind of burn, and the mindset of the founders is more of building a business, then you should be approaching Equanimity. But if you're a founder and you're backing up a business where you're saying, वो business बनता रहेगा, पहले valuation बनाएंगे, so, and if you approach us, I can assure you it will be a waste of your time.
Cool. You have a fan moment here. Abhishek is happy with the way
Uh-huh.
you are answering. Taking to the next question, Harsh is asking about what insights you would like to share with tech startups which are at early stage, kind of.
Yeah.
What insights? Any insights, trends which you would like to share with current times?
What insights about tech startups? So I
Yeah.
think by definition, if you're a tech startup, what I look for, at least for a company that is or a business that is more tech oriented, is that in the founding team, or at least among their senior hires, they have somebody who's a business guy, right? Most tech startups that I've seen that have been successful have had some business guy as part of the leadership team. Because for companies that are very tech oriented, or for founders who are very tech oriented, it's very easy to get lost in trying to build the best technology and the best tools, etc., which is what the market needs, and there's no question about that. But you're trying to build a business, and to build a business you need a business mindset there. So, rather than waiting for a perfect time or a perfect technology or a perfect, setup to go out into the world, the business guy, because he is more revenue driven, more business driven, will be the person in your team who will keep pushing you to be out there in the world. Launch whatever you have, get feedback, keep improvising slowly and gradually, and not be too fussed up about having the best tech out there. So this is one very simple thing, but I think it goes a long way in most tech startups that have succeeded. In some of them in my portfolio as well, have been companies which have seen some kind of business orientation. Now, don't get me wrong, you don't need a third party to be a business person, right? If you think you are a tech founder, but you have that business mindset, awesome, right? Great. But if you don't, then and it's not just about this tech aspect. There's one very generic, advice, again, learning from my experience, is that all founders and all of us actually should be doing a lot more self evaluation, and we should have the ability to look into the mirror and figure out what areas are your strengths, and everything else, right? Forget about whether they're weakness or not. Identify your areas of strength, and every other area, fulfill it with the right kind of people. Somebody asked me earlier, how do you build a team, right? This is how you build a team. You figure out what are your strengths area. You know that, okay, A, B, and C, these are my strengths. Now, anything that has got to do with D, I'm sure you can do it, but it's better to get an expert to do the D and the E and the F, right? So that will be my advice to tech founders and tech startups.
Awesome. That was a great answer. Uh, there is one question from Dr. S.D. Mishra. He's trying to teach startup for which are postgraduate students. Would be the best way to encourage them? First thing they would need to know about financial terms, right? What kind of financial terms this startup should know about?
Well, so I think if you are training people in the area of startups, etc., uh, the best way to train them is to send them out there in the real world and ask them to really, first of all, make a business plan and try to pitch it, right, to investors, family, friends, third party, angel investors, high net worth investors, VCs, other institutional investors. I think there's no better place to learn about startups and how to raise funds, etc., than being out there. So I'll give you one of my experiences when I was at Wharton. One of the professors, it was a whole course that we had on building a business plan. And then after you build a business plan, it's not a theoretical business plan. You have to go out there and get it funded, right? You have to sell that idea to people. Now, when and regardless of what happens after that, I think when whether you're postgrad students or you're really entrepreneurs, when you're trying to build something to be sold, the whole thought process, the whole questioning that you will go through while building it up, even if it is just a plan on paper, is going to be very different, because now you start asking yourself very realistic questions. You're not just doing an assignment for a professor. You're really making a business plan that might get funded. So the way people think about, as a student, I think will be very helpful if you allow them to really build projects that can be funded by investors. And I think, Sanjay, I mean, I don't want to speak on your behalf, but something like what you're doing can play a very important role here. So if a professor has postgrad students who are interested in startups, you or me or us or combination of investors can really align with these kind of folks and say, what, build a plan, and if it
Sure.
is realistic, we will fund it, right? Now,
Absolutely.
just this whole carrot of getting funding afterwards will make the postgrad students really ask themselves all those hard questions when they build their plan.
Sure. So next question coming up from Vinay is: do VCs help validate product idea?
Of course, VCs can ask you the toughest of questions, and they have no other agenda than to make sure that your product or your idea is the best. Because if it is not, they just throw it out of the window. I mean, it's very clear feedback. You go to them and you make a presentation, and they say, this is all bullshit. That's feedback, right? Don't take it negatively. That's feedback. You got to understand not only why that VC thinks you're bullshit, but you then have an opportunity to really fine tune whatever you're doing Either it is your product, your idea, your technology, or it is just the way you're presenting. But take every meeting as a feedback meeting. We do the same, by the way. VCs are no different than entrepreneurs, and I must highlight that. So as VCs, we do fundraising also. We meet a lot of investors who keep saying no. So it's not that only founders come to VCs and the VCs are not giving them the money. I mean, trust me, every VC, including the largest of them out there, have to go out there and ask for investments from their investors. And they don't always get said yes. You have to do a lot of meetings before you are able to raise money. So take every meeting as a feedback meeting. Try to keep improvising your own pitch and your process.
Sure. It's all about pitching, pitching, and pitching. What are the right? What's the right tick boxes Nitish is asking before reaching out to an early stage funding for the company? Or any tick saying that this is one, two, three, four, five, which you should do?
Yeah. I think again, this is a very generic answer that I'm going to give, and it will be very specific for every business plan that every founder is making out there. But generally speaking, your basic hygiene factors have to be in place. Before you approach any investor, you should have clearly spelled out your idea. So, what is it that you're trying to do, right? And what is it you're trying to do? What problem does it solve for your customers? So, therefore, you will have to know who your customers are, what are their needs, how what you're trying to build up is going to help their problem and make their lives easier. So these are very basic questions that you need to have in place. Third is the size of this opportunity. So how many customers are out there who can benefit from whatever it is that you're doing? And for that, pleasure in their life, how much are they willing to pay you? So what's the size of this market? How many customers are there? What kind of price points you can have? And these are all, it's an early stage, right? So there is no proof of concept as yet. You haven't been there. It's not a scaled up business. So these are all assumptions. But you have to have those assumptions rooted in some kind of background reality. So therefore, I always say, startup is a lot about passion, but it has to be balanced with a very healthy dose of research. So as much as you are passionate about your idea and your technology and what you're building up, please make sure that you're doing as much or even a little closer, in terms of amount and focus. You're spending as much time on research about your passion. So what's the market size? And then the fourth part to that whole thing, which investors are looking for, is your plan. So now you've told me that you're building this and you've said that these are the customers, this can be the size. So what is your plan? How are you going to execute it? Right? Who are the people you need for this plan to be executed? So therefore the team. So who's the team going to be? And you may not have the team set up because you're just starting off, you don't have all the answers. But you know that you need one person for business development. You know that you need somebody for tech specs, etc. So we need to see as an investor before you come to us that you've thought through everything, right? You're not coming here and saying, let's think together, right? You've thought through everything. The process when it starts will be let's think together from an investor's point of view because it's okay, you've thought through, but here are our thoughts. And now let's see where it all merges and what's the best path forward. But it helps a lot for investors like us to see entrepreneurs who come to us are very well prepared. The worst thing that you can do in a meeting is when asked a question and you say, "Oh, I have no idea," right? I think that just shows that you're not very well prepared. And if you ever to answer, and I have done that as well, by the way, I have said in meeting that no, I have no idea about what you're asking. Make sure that you go back and you get that answer, right, for that investor.
Sure.
So
So that
that's how I
brings
would go
to the
about it.
next question. What Palak is asking Rajesh, what
Uh-huh.
are the things that irritate or turn off investors, right? What would piss off an investor, when founders reach
Oh,
out and pitch them? You will have a
well,
laundry list, but please share a few.
yes, yes, yes. No, Palak, I think, as I said, you have to give the benefit of doubt to investors that they are all meeting you or spending time on your pitch deck because they want to invest in your business and they want to back you up. I think that is a starting point. Uh, but when you approach investors, there are certain things that investors get put off by. Right, one is tardiness. I hate it. When there's a meeting at 11 o'clock, and you're not there at 11, right? It just doesn't make sense. And I mean, I've been working for nearly 25 years, and I've heard all kinds of excuses. I can tell you, the train, the car, Bombay, traffic, flights. We all know that, right? We are not exposed to a new ecosystem. We all live in the same ecosystem. So I think, the one thing that I think puts a lot of investors, or at least puts me off, is tardiness. I mean, you have to be on time. You have to be prepared for the meeting. That's the other thing that investors don't like, and I've seen that across many investors. If you are not prepared and you're coming to for a meeting, that just goes to show that yeah, I mean, why will someone trust you with their money if you're not prepared to get into a meeting at least? That's like a basic hygiene factor. So you have to be, whether you like it or not, you have to be presentable, right? I'm not saying be formal and tie and, yeah, I mean, no, not that way, but you have to be ready for that meeting, right? If you are not ready for that meeting in terms of your presentation, in terms of your preparedness, in terms of being on time, etc., then that's a huge strike off against you. Second is a presentation that you're making. I don't always seek founders to come to our meetings with a standard PowerPoint presentation. You may come just yourself. I don't need a presentation, but the clarity of your thoughts has to be there. I don't care, but you're presenting. So if you're presenting your thoughts, your ideas, everything has to be in a flow, and that has to come across in that meeting. And the most important thing is, the passion. If an investor, most of us, we keep. So by the way, most investors keep meeting entrepreneurs all the time. So in a day, I'm sure Sanjay is doing at least a few meetings every day, whether it's physical or Zoom calls or phone calls. We keep talking to entrepreneurs all the time. So we know just by experience, sheer experience, the passion that you bring to the table. You have to do nothing for us to feel that passion, right? You just have to be there, whether you talk or not, whether you present or not. So that passion has to come through, and that will come through only when you have it. So these are few things which, if they are missing, then I think they are a turn off for investors.
Sure. We got one more question. I mean, there are enough of it. I'm just picking up basis on,
Yeah.
repetitiveness, but this is a unique one with Saurabh asking across your impact on evaluation when there are distributed teams. If teams are in India, one founder is in outside India or in multiple cities, would you invest? Distributed teams, do you evaluate?
So we do. As much as I think it's a challenge for the startup, it is a challenge for investors as well to evaluate these kind of startups. Uh, Especially, I mean, the last 3 months have been an eye opener for everybody that everything can be done work from home, and you don't really need to congregate in one place to meet. So I've been a believer of distributed workplaces, for a long time. Just for background information, I spent nearly 18 years with Templeton as an organization, and I was working with the emerging markets team where we had 18 offices across the world. So at any point in time, I was working with folks across the other 17 offices. So distributed work, I have no problem with, and I think most investors who have been there, done that, have no problem with distributed teams. I think where we struggle is with founders who are very early stage in their business ideas, etc. We are struggling to figure out whether you get it or not. Conceptually, as a founder, you may say, what, two of my guys are in Bangalore because that's where the resource is, and one of my co-founders sits in the US because that's where the market is going to be, and I'm here managing the business and the business development and investor relations. I mean, we've seen many of these kind of businesses. Our struggle here is for you to convince us that you guys get it and you are able to function as a cohesive team despite the distance. So I think the onus is more on the founders, like yourself, to demonstrate to investors like us that you understand the challenges of distributed working and have managed it in the past.
Sure. So, Rajesh, quickly moving, I've taken your extra time now. We are touching 45 minutes. Another 5 minutes, hope you can extend across with us.
Sure,
So,
please.
what are your views on valuation and deal making in India?
I think India follows the same. So valuations and deal making follow the same pattern, I think, in most parts of the world. Everybody wants higher valuation, lower dilution, and everybody wants the deal to be done right now. And there's no difference whether you are sitting in China or the US or Israel or wherever. I think in India, so we have but that said, that everywhere it's common. There are certain traits which are very peculiar to India, and one of them is this aspiration to feel that fundraising is success, business success, and I think that needs to change. Just because you raised money at a higher valuation doesn't mean you're a successful business. You still have to use that capital, and the more the capital you raised, the more challenging it is for a startup to generate the ROI on that enhanced large base of capital, by the way. So I think in India, what I was trying to point out too is that founders don't understand this challenge. That if you can deliver something with $1 million, please don't go and raise five. Right? And I have seen this advice being distributed so all over the place, saying that jitna paisa milta hai raise karo, right? Uh, I mean, I think differently. I think raise as little as you can to execute the plan. Right? Again, there's no fail safe strategy here. This can be wrong at times, and that can be wrong at times. But I think one of the things in India on valuation and capital raising is don't raise much more than what you need, because so look at larger businesses, and I'm sure all of us have heard of the gentleman called Warren Buffett, and he himself has said, on record a few times, that I can, and I think he said that recently somewhere, that I can assure you that if I had only $1 million to invest, I can deliver 50% IRR over a long period of time. But if I have billions of dollars to invest, then I can't. Right. So that challenge of the size of capital applies to all of us, including VCs and early stage investments. In terms of valuation, are they frothy? I think we go through the same cycles, Sanjay. There are times when valuations are frothy, then there are times when valuations are reasonable. I am yet to come across a time in our ecosystem, and I've been involved now nearly for 14, 15 years. I'm yet to see a time when valuations are beaten down. I've never seen that time in India in the early stage ecosystem. It's either frothy or reasonable, in my opinion. I think today's scenario, we are finding a lot of reasonable valuation companies around, and it's got nothing to do with COVID. I mean, it's just been the way it is. I think given the slowdown in the overall economy and what's happened to stock markets over the last few years, we are finding a lot more reasonableness in terms of valuations than frothiness. So
Sure.
that's our view on valuation.
So how would you position Equanimity as a venture capital? How different it is from other VCs? What is the unique value proposition what Rajesh Sehgal brings on the table for startup entrepreneurs?
Yeah. Uh, I think so. We are not trying to differentiate ourselves from everybody, Sanjay. But I think when founders approach us, I think it's important for them to realize and understand that this is an investment firm that really believes in backing ideas over the longer term, provided one. So two things. One, you're chasing not valuation, but you're chasing a dream to set up a large business. I think very, very important. So if you are an entrepreneur, and I think inside we all know who we are, right? Whether we say that or not is separate, but we all know who we are. So I think if you're an entrepreneur who's seeking, who's really wanting to set up something meaningful and large business, no matter what sector, what scale you are at, Equanimity is interested, right? That's one. Second is, as Equanimity, and again, I said that I'm not like distinguishing ourselves from every other investor, but it's extremely important for us to believe that we are working with the right set of people. So we spend a lot of time in figuring out and allowing the founding team and entrepreneurs to figure out that they are in good company, and we want to be assured that we are in good company. So I've been a big believer of this very simple thing I was taught as a kid, that you are as good as your five close friends. So the more time I want to spend more and more time with good people, and with the right set of people. And that's, I think, what we strive for.
Sure. If
Yeah.
you had to pick up three sectors successful in future, three sectors, what would those three sectors be?
Oh, that is simple. We've as I said, we are sector agnostic. We invest across sectors. But that said, where the Indian economy today is, I think the three sectors that I would pick. One will be consumer oriented. So
Mhm.
so India remains a consumption market,
Mhm.
and you have tons and tons of opportunities to set up large, scaled up, meaningful businesses servicing consumers in one way or the other.
Sure.
Then other areas I would, I'm finding a lot of opportunities there is, the other two areas will be fintech and edtech. So I think there's lots happening in the financial space
Consumer,
and the
consumer,
education space.
fintech, and edtech. Consumer, fintech,
Edtech,
and edtech
yes,
are the three areas what Rajesh is very keen to look at while he is doing diverse set of stuff. Fantastic. Uh,
exactly. Yes.
views on 100x what we are doing across. This is my one question which every you are forced to
Yeah.
answer. What we do at 100x, what are your views
Yeah.
on it? And 100x model about the first check investing, where we build a class and kind of it's like a batch mode, factory kind as a discovery platform. What's your view on that?
Yeah. Sanjay, I'll just repeat what I told you the first time you shared that you had this idea and you were trying to go down this path. I still remember we were standing outside Grand Hyatt, when you told
Sure.
me this. And I said, this is awesome. This is what the ecosystem needs. So to have a rich ecosystem, you need to have players at all levels, right? You cannot only have larger funds and you cannot have only smaller funds. You need funds at all kinds of, you need capital to support business at each level. And I think
Sure.
what you're doing is amazing. I think of it as discovery, and I would love to participate in one way or the other in what you guys have done. And I must share with you guys on this on this platform that my mentor, Dr. Mobius, was also very excited when I was just discussing your platform with him, and he said this is amazing. We should do this across other countries as well, because this is
Oh,
how you incentivize and encourage entrepreneurs to really give shape to your dreams.
thank you so much. That was great. Made my day, Rajesh. On the closing note, your advice to startup founders: three things that they can do in short term, and three things they should not be doing in short term.
Ah,
They
wow.
should be doing in short term three things, and they should not be doing in short term.
Yeah, I think so. One of the things that you have to be very long. So three things that you have to be long term about, is one is your business plan. Please never make a plan for the short run. Your overall plan has to be for the long run.
Sure.
Two, funding sources. Never look for, if possible, never look for short term funding sources. Always look for longer term capital, right? And that's, I think a given. And third, again, a longer term thing. Sorry, I start with longer term because that's our orientation. uh, when you're building a team, always look for people who you think will stick with you over the next 10 years, right?
Sure.
Don't look for people, however awesome that person is. If he's changed 5 jobs in 3 years, it says something, right? So please look for people who are longer term in their approach. So these are three things I would say. Don't be short termist about these three things. What you need to be short term about, in the short run, what you need to do is you have to get your tactics right. So, for example, even in our portfolio, a lot of our companies in COVID times have steered away and started doing or selling things that are selling nowadays. So they're selling
Sure.
sanitizers, they're selling PPE kits, all of that, which is not their business model. So it's very short termist. But I think in today's time, that's required. Your whole focus of an organization today or the last 2 3 months has been one of survival mode. So you have to be very short termist. Even though you have a very long term business plan and this doesn't align with that, I think cash flow. So in the short term, the one thing that you have to be very short term about is, as a startup, is cash flow. Make
Sure.
sure that you are not doing business with people who are not able to help your cash flow in a positive manner, which means focus on inventory, focus on receivables, everything about your working capital. Just be very, very short term about it, right? So that's one thing I would be very short term about. Second, in the short run, what I again encourage a lot of people to do is there's a book on it called Small Bets. So keep doing small bets, and small bets by definition should be short term. So you have to be very quick, in the short term to decide whether that small bet has paid off or not. And if it has not paid off, just shut it and move on, right? So you have a larger, longer term business plan, but you have to keep moving these short term bets on and off. So I think these would be areas that I would be very short term about.
Awesome. Thank you very, very much, Rajesh. We overshot by almost 15 plus minutes. It was pleasure listening to you. And lastly, if any founder has to reach out to Equanimity or yourself, is there any address you would like to leave with audience?
Yeah, I mean, anyone who wants to reach out to me, if you go to my website, equanityinvestments.com, and we have a link there called contact. Just send us an email over there. And it's a very busy email ID. We keep getting tons and tons of email there. But feel free to write to us at that ID, and someone from our team will definitely reach out to you.
Awesome. That on that positive note and fantastic insights from Rajesh, ending up the session today. And have a great week ahead. Thank you, Rajesh, for coming on 100x Live.
Thanks, Sanjay, and thanks everybody for a patient listening. Look forward to the next session.